Hello and welcome back to our webcast series on connectivity between IFRS accounting and IFRS sustainability. We have a joint team of IASB and ISSB presenters for this series. My name is Gabriel Benedict, and I'm a part of the ISSB technical staff.
And my name is Gustavo Olinda, and I'm part of the IASB technical staff.
This is episode 3 of our webcast series. As explained in our first episode, in episodes 2 to 4, we will walk you through a series of examples where we look at the reporting outcomes of applying both sets of our standards together. We have prepared these examples to illustrate how applying IFRS standards together as a package results in connected and complementary reported information. Our examples for this series are focused on climate. As shown on this slide, the examples cover 3 topics: climate-related risks and impairment of non-financial assets, climate-related opportunities and changes in product mix, and climate-related commitments. In this episode, we will cover our second example, which is about climate-related opportunities and changes in product mix. Before watching this episode, we invite you to watch episode 1, in which we provide a theory refresher and explain how our standards are designed to work together.
Now, we have a few housekeeping points that apply to all of our examples as we explain on this slide. We would like to emphasize that these examples are basic illustrations of how IFRS standards work to support complementary and connected information. The examples do not illustrate all requirements in IFRS standards, nor do they provide a complete set of illustrative disclosures. From the ISSB standards perspective, we will focus on 2 areas. Firstly, we will illustrate how disclosures about the current and anticipated financial effects of sustainability-related risks and opportunities expands on and complements the information in financial statements. Secondly, we will focus on other disclosure requirements in the ISSB standards that are of particular interest in the fact patterns discussed in illustrating complementary and connected information with the related financial statements. The examples follow a consistent structure. We will first discuss the information reported in financial statements, followed by information reported in sustainability-related financial disclosures. When we talk about information in the financial statements related to the climate-related risks and opportunities described in the fact pattern, we will consider, first, whether there is an effect on the recognition and measurements of assets, liabilities, equity, income, and expenses. So, is there an actual effect on the amounts reported in the financial statements? Second, if the recognition and measurements are affected, whether disaggregated information about those effects is provided in the financial statements. So, is that effect visible in the financial statements? And finally, the examples will consider what other related disclosures are provided in the financial statements. As I mentioned before, in discussing information reported in the sustainability-related financial disclosures, we will focus on current and anticipated financial effects related to the climate-related risk or opportunity, and other disclosure requirements that are of particular interest in the fact patterns discussed in illustrating complementary and connected information with the related financial statements.
So let's move on to our second example. We'll now look at an entity taking advantage of a climate-related opportunity. In this example, the entity we'll consider is a vehicle manufacturer. Traditionally, the entity has focused on the production and sale of internal combustion engine vehicles, or ICE vehicles for short. To support the sale of its vehicles, the entity also sells spare parts and provides financing services to its customers. The entity has identified a climate-related opportunity and decided to move into the production and sale of electric vehicles, or EVs, in addition to ICE vehicles. In 20x0, the entity has set a target for EVs to represent 60% of the total number of vehicles it plans to sell by 20x8. To achieve that target, the entity plans to modify its manufacturing processes to increase its EV production over time. Sales of EVs begin in 20x3, but are still relatively small compared to the entity's overall sales. For the purpose of this example, we will look at what information the entity would disclose in 20X3 when it begins to sell EVs.
As Gabe just mentioned, during 20X3, the entity made some sales of EVs. As you would expect, the entity would recognize the related revenue from these sales and the inventory for vehicles not sold at the end of the reporting period, for both EVs and ICE vehicles. Now, coming to the main aspect of this example, we note that IFRS 15 has specific requirements for disaggregating revenue. In particular, IFRS 15 has a disclosure objective that requires an entity to disaggregate revenue into categories that depict how the nature, amount, timing, and uncertainty of revenue and cash flows are affected by economic factors. The standard also states that an entity might be required to disaggregate revenue into more than one category to meet that objective. The actual categories used to disaggregate revenue in this example would depend on the specific facts and circumstances of the entity. Because this is a simplified example, we cannot reflect every consideration an entity would take into account in determining how to disaggregate its revenue. However, possible disaggregation would include revenue by major product lines, such as revenue by vehicles, spare parts, and financing, and by type of vehicle, such as revenue from sales of EVs and ICE vehicles. Inventories would also be disaggregated into appropriate classifications, applying the requirements in IAS 2. And finally, I note that there are some other disclosure requirements in IFRS 15 and IAS 2 that we have not illustrated here. Now I will hand over to Gabe for him to tell us about the sustainability side.
As noted in the fact pattern, for sustainability-related financial disclosures, the entity identifies a climate-related opportunity related to the sale of EVs. In providing information about how this climate-related opportunity has affected financial position, financial performance, and cash flows in the current reporting period, the entity might provide information about the amount of revenue from EVs and ICE vehicles, in addition to the effect on levels of inventory in the period for both types of vehicles, because this information is fundamental to the entity's transition plan. When providing information about how it expects its financial position, financial performance, and cash flows to change over time, the entity might provide information about its transition to EVs. This information might include the expected growth of EV revenue and related effects on inventory, and the capital investment needed to support this transition and growth plans. Other information an entity might provide about this transition plan includes any expected changes to its business model, including resource allocation to implement these changes, targets set out for EV sales, and information about how the entity is resourcing and plans to resource its transition plan to achieve these targets. In providing information, the entity would also consider relevant industry-based metrics for its given circumstances. Reflecting on this example, the main point that it illustrates is the application of materiality in different contexts in the financial statements and in the sustainability-related financial disclosures. In episode 1 of this webcast series, we took a deep dive into the concept of materiality. Now, what this example shows is that you could have different disaggregation of revenue and inventory in the financial statements and sustainability-related financial disclosures because these reports serve different objectives and follow the respective applicable reporting requirements. So when you think about disaggregation, you're thinking about the objectives of the report and the objectives of respective disclosure requirements. And when you present resulting information, you're providing a connected package of comprehensive information to meet the needs of primary users.
And it's important to note here that applying materiality in different contexts could, but not necessarily will, result in different disaggregation. Of course, this conclusion is reached in the context of the entity's specific circumstances.
That brings us to the end of the third episode of our 4-episode series on connectivity. We hope this webcast was useful in illustrating how IFRS standards provide connected and complementary information when it comes to information about the effects of climate-related opportunities and the resulting changes in product mix. We're looking forward to having you join us for our next and final episode, where we will walk you through an example about climate-related commitments. Thank you for joining us.